Today, folks, we're diving down into my two favorite monthly paying real estate investment trusts of all time for them juicy dividends. And thanks to you beautiful, diverse community out there, one of these is Canadian and one of these is US. So hopefully you kind of enjoy that factor around it, because going into the pandemic here, folks, when people, the likes of Kevin O'Leary, were saying, I'm selling my retail, I'm selling my office real estate, I took the counterpart position and I said, you know what? These things are too cheap. They're trading at massive discounts. They're going to be incredible recovery plays, at which I loaded the bloody boat to, oh my God, what a good turnaround story here, leading into the end of 2020, where we finally have the fiscal year end earnings to see how these things are actually doing. So consider slapping a like, because we are going to get into what these companies I think are going to be worth in the future, because you OG subscribers know exactly what I'm talking about as we zoom out, taking a broader view of my portfolio. Of course, RioCan Real Estate Investment Trust, Canada's largest REIT, highly focused on retail, office, and now moving into residential, making up over 10% of my portfolio today. It has not been updated for the recent rally. And then in numero dos, we got to talk about Stag Industrial, making up 3%, of my entire portfolio. Not nearly as big of a position, but I am trying to scale it over time. And actually, I think Stag might be a lot bigger than that. I think I'm misappropriating it because it's a $9,500 position, and even more than that because it's rallied since I bought it. But before we dive down into this information here, folks, I want to remind you, if you enjoy the way I track my portfolio, we have way more in-depth portfolio trackers over at the chartmaster.com here, guys. And you can use coupon code Passive Income Investor, 15% off. Support the channel a little bit. It's super awesome, super dope. But we're going to put that aside, and let's get into this by talking about RioCan, which many of you are aware is a retail, office, and now moving into residential REIT in Canada, highly focused in Ontario, where I live, my backyard, Toronto here, folks, with the stock currently trading down a healthy 33% from its highs of 2019 going into 2020. Now with a 5.23% dividend yield, that came after a cut. So yes, we have experienced a dividend cut, but I don't think it was implied that it was needed. I'll explain more, but let's get into their just earnings, their books here on Yahoo real quick, because now we can see the fiscal 2020 year end, where they produced about $1.1 billion in revenue against 2019 when they did about 1.3 billion, meaning they see a discrepancy of about just under $200 million in losses in revenue, which hurts a little bit. Yes, it sucks here, guys, but considering the kind of real estate investment trust this is, pretty robust in my opinion. If we look at this chart, you might think they're losing earnings, but let me gladly remind you, new investors out there, real estate investment trusts don't operate exactly like regular companies. They kind of operate like cars almost. You know, if they lose tenants or they have issues in a building, they'll write it down against the revenue, so they don't have to pay as much tax, but it also makes it look like they have no bottom line earnings, which just isn't true, because obviously, as I tell you guys, and as my boy Matt Money always likes to remind us, you want to go into those earnings, you want to take a look at that FFO, and currently for the last quarter, they did 39 cents, but more importantly, looking for the fiscal year end, they did $1.60 per unit in funds from operation against 2020 when they did $1.87, so that's where we get those billions of dollars we were just looking at in revenue here, folks. But a lot of people think they can't afford the dividend. Just not true. They lowered it to 0.9 cents, which on a quarterly basis is like 27 cents. So they're a long way from the 39 cents. So some room to actually expand it if they so choose, but they just wanted to protect themselves in the uncertainty, because with the old dividend payout was around 12 cents, or the equivalent of, if I'm doing the math in my head correctly, is 36 cents a quarter. So if they didn't do the dividend cut, they could still afford it, but they would be very, very close. And obviously that would be slightly concerning. So putting that aside, more importantly, when it comes to REITs, obviously we want to make sure they have those tenants in base, in control here, folks. And taking a look at the total cash collected for 2020, it was 91.8%. So we're seeing about just over an 8% discrepancy there, with deferral rents with definitive payments at 2%, then provisions for rent abatement and bad debts at 5%. Hopefully you guys can see this. I'll move it down so my head sits up a little higher here. So we can see that 5.2% is their worst tenant basis, but honestly, is that really that bad, guys, for considering what we just went through? I don't think so. That's why I loaded the boat. And now I'm really happy I did, because my goodness, are we collecting here, folks? But more importantly, I don't want to get into some of the nitty-gritty details I used to about this company. There's plenty of those videos you can find here on YouTube. I want to tell you guys why I think this stock is still an incredible buy today for somebody looking for decent monthly income from a stable REIT. Now, a lot of people may argue this. They may see it differently, but this is just my humble opinion here, folks. At the $18 share price, still trading down a whopping 30%. The only thing that really matters is now we know they've got a good 90% base of collection. So how can we grow from here? Well, take a look at the development pipeline. In here, we have 8 properties, and I went ahead and did a stupid amount of math, and I took all the residential, all the apartment buildings, I took all the square footage for retail space along with office space, and I ran some math on generally what these things go for in Toronto as of today, and especially in the areas, because I know the areas really well, and I'm going to actually tell you over the next, by 2025, how much revenue these things are going to generate. And let's start with the apartments, okay? They're going to have 6,855 apartments coming online, literally in the next 3 years. A lot of them already are coming online this year, but nonetheless, if we times that out by $2,000 a month in rent, which by the way is a good median, that's actually a lower end for the part of the city they're selling in, and they have some other properties outside of the city. So I imagine the average rent would be anywhere from $1,500 to maybe $2,500 to $3,000 a month. So I figure the $2,000 probably an underestimated median. But if we times that out and then times it by 12 over the year, these apartments alone are going to equate to about $164 million, in my opinion, on the low end in income if they're 100% rented. Let's talk about retail space here. If I can even say these numbers because they're so astronomically huge, they got about 1.35 million square foot in retail space coming online, not including anything they have now. And the way we calculate these average costs, it's very challenging actually because it's variant depending on areas. So I really took a decent median here, but if we take a look at the map of current leases available in downtown Toronto, they're roughly $60 a square foot per year. And that's on the low end here, guys. Usually they can range even up to $100+ a year. In square footage. But nonetheless, I took a good median of about $70 a square foot. And if we times that out over that whole entire yearly square footage, we're looking at some pretty crazy numbers. I mean, we're talking about another $95 million in potential revenue income here. And then finally, let's just talk about the 1.1 million in office space. This is going to be the office space that's going to be rented to tenants such as Shopify, which already said they do not plan on pulling out. Even in the work from home lifestyle we're living, they're still planning on moving in. I think it's actually this year they move into this building. But nonetheless, the 1.1 million square feet, again, office space treated a little bit differently in Toronto because just taking a look, we can see that their leasing could be anywhere from $40 to even $60, sometimes $70, a little less than retail. But nonetheless, I took $50, times that out. What are we looking at here, guys? Another extra $55 million a year in potential revenue. We take all those numbers, we add them up. What do we get, guys? About 314 million, and I truly believe that this is a decent, moderate median. I could presume that they could excel past this, but this is, I think, a good rough expectation if everything was 100% rented out. So if we take the 300 million, guys, and we go back to RioCan's page here, we take those numbers and we presume that this is going to be the base median for moving forward of around 1.1 billion, guys. Add that 300 million on the low end, maybe 1.5 billion on the high end. I would say maybe 1.7, 1.8 billion, which means we could see an increase of somewhere between 30 to 40% over the next 3 to 5 years, which I think is super healthy with the dividend we're getting out from this REIT. And if you also include the fact that the real estate value in Toronto continues to go up, their underlying assets are going to continue to grow in value, which should give us some more bottom line asset value to add to that market cap over time is what I'm hoping. But when you already look at the fact that the stock is trading down a whopping, like I said, guys, 33%, considering they're still collecting over 90% of their rents, it shouldn't be trading down realistically more than 10-15%. I'm glad that my average buy is around 17. I was buying in the high 19s all the way down to the low 14s, and my average is beautiful here. But I believe that the stock price should be $18 to $20 based off what they're currently doing. But if we see these projects come into fruition and it actually bottom lines to the earnings, this really should be a $30 or $40 stock. So there is some huge upside capability here, in my humble opinion, which is why I really like it being one of my largest positions. So putting that aside, guys, let's talk about numero dos. Let's bring Stag Industrial into the picture. This is another REIT that I chose that I love with a passion. It is the same size as RioCan. It's got a $5 billion market cap. It's a little more expensive. We're paying a pretty hefty premium for this at a 4.5% dividend, a little bit lower, but you're getting a growth rate that has actually survived the pandemic, whereas RioCan obviously getting slaughtered. But let's talk about this because Stag Industrial, if you are not aware, basically just operates these logistics centers, and their tenant basis is absolutely incredible because, again, Amazon is their largest tenant at 3%. And then they got general service service administrations. They do everything for Ford Motor Company, GM. They do stuff with Tesla in here, and they are gobbling up properties like they're friggin' candy right now. This is a future forward-leaning REIT, in my opinion, because it's operating primarily on the future of e-commerce. It doesn't matter what business you're running. Even Amazon is just a logistics center, guys, and they're just running out of space endlessly. So it makes a lot of sense that this company is able to partner with them and drastically expand, which we'll see when we get into their books, because this one, not nearly as impressive on the revenue side, which again is kind of hilarious when you kind of compare this against what RioCan is doing. You're definitely paying a hefty premium for the cash flow, because if you take a look, they're currently generating 483 million for 2020 against 2019, where they only generated 400 million. Again, this is US versus CAD, but still drastically different numbers, right? So this is absurd. Guys, for a REIT to have this kind of growth rate is almost jaw-dropping, in my opinion, considering in 2018 they were only doing 350 million. And just look at this juicy chart. Oh my God, look at the earnings per share going from 49 million in 2019 to 2020, where they did 202 million. This is just a sign of the times. This is a REIT you're going to want to own. You're going to pay it up front, though. I'm telling you that right now. It's not cheap. But oh my God, if you believe in e-commerce, if you believe this is the way the future is headed, this is a leading company in the industrial sector. And we could talk about the dividend here as well really quickly, guys, because this is a company unlike RioCan, where RioCan cut the dividend. This one has been increasing it year over year. I don't think it's been increasing it enough for my appetite, because really it's only gone, for the last 5 years. If we go back to 2015, we can see it went from basically 0.115 to now we're only getting 0.12. So we're not talking about super huge increase, right around 20% give or take. But again, when you match that dividend growth to the capital gains, even though I don't plan on pulling capital gains off of this, it still combines very, very well here, folks. There's one thing I want to talk to you guys about, but the big difference is my boy Matt Money, my business partner, we discussed this, and I think it was really appropriate that he brought this up, because I kind of overlooked it. You have to understand, because when I looked at the numbers on their sheet, I was like, how is this company not growing faster? You think the capital gains or the dividends would be exploding, and I'm like, how are these companies making these acquisitions? How are they acquiring so much? Because RioCan is focused on a development pipeline. They already put all this money into these properties, and it's kind of just a waiting game. But I was like, what is Stag doing for their future? And I realized that the way they're buying properties is by simple share dilution here, folks. So we can see that year over year, this is a company that has done basically annual share dilution, going from 2012 when they basically had like 25 million shares outstanding to today where they have 149 million. This is what has been impeding the stock from exploding, in my opinion. But again, this is what they're doing to continue to add share value, continue to increase revenue, cash flow that allow them to increase the dividend. And like I said, at least we're still getting a nice capital growth behind it and a lot more stability than obviously we're seeing in something like a RioCan. So I think these things complement themselves really well. They haven't really been doing much on share dilution at all. There was a period where they started buying shares off the table. Then there was moments not that long ago when they added shares, but they're really not doing too much. But overall, their share dilution is very nominal to the point of it affecting the actual stock price. But these are the things that you have to kind of balance. It's like a juggling act. I truly believe that if you're looking for monthly income, these are the kind of companies that you want to buy, not only for capital growth today, but also getting cash today to reinvest elsewhere. Now, these things come at different tax implications, but basically what I've given you here is a complete recovery play that is on a Canadian side of the border and a complete growth REIT on the US side of the border that both offer incredibly healthy starting yields that are likely to continue to increase them, because RioCan, when these projects come online, I'm telling you, the first thing they're going to do is reinstate the dividend. And heck, it wouldn't even surprise me if they start issuing share buybacks with all the extra cash they're saving from the dividend cut. Because remember, they didn't have to cut the dividend here, folks. And I pass the question off to you. What do you think about these two REITs? They are my personal favorite. I'm continuing to add to Stag. I am no longer buying RioCan because I don't like when these positions get this big, especially on days like today where they're still exploding, right? Like even just taking a look, let's refresh the chart and see where RioCan is at right now. It continues to hold look at the daily high here. I mean, we're trading up almost 3%, 3.4 from the bottoms. Right? Absolutely incredible. So stay cool, stay awesome, and I look forward to catching you tomorrow.